Let's have a look at a simple exercise to see where each item goes. Let's see where each item will fit on our balance sheet. Cash. Cash, it's our company's money. So it is money for the company. It is cash item that belongs to the company. Everything that belongs to the company will have to go into assets. As I said, assets is what belongs to the company. Liabilities is what the company owes. It's not for the company. And equity is simply an equation. Assets minus liabilities equal equities. So cash belongs to the company, so it is considered as an asset. Equipment. To do our business, in the startup cost, we said we need to see how much equipment we need to invest in. So when we buy the equipment, these equipments are ours. So they are considered as assets. Client savings. If you have clients who put your money with you, so as a client, not as an investor, as a client, you have to give him back his money. So that saving in itself is not ours. That saving is a liability. This liability, we have to pay it back. So everything that we owe, we have to pay it back. Client saving is one of the liabilities that we have to pay back. What about the net deficit of the current year? We said in the income statement, it is revenue minus expenses. Revenue minus expenses equal profit. The profit will be added to the retained earnings. Thus, during a certain year, if the revenue is less than the expenses, and we went during the year into a loss, that loss or deficit, we have to deduct it. We have to take it out from the retained earning. And the retained earning, as we mentioned before, is part of the equity. Just to refresh our memory, equity has investors and owners' money, and we have the retained earning as well. So profit is added to the retained earning in the equity part. Losses are deducted from the retained earning or the equity part. Let's look at restricted or deferred revenue. Restricted or deferred revenue, we can simply talk about a magazine that takes upfront the money for the subscription. So when you subscribe to a magazine for 1 year, you pay for the full 1 year. And when you get the magazine at the end of 1 month, the company already is holding 11 months of revenue that are unearned. So these are unearned revenue, money that you receive in exchange for the magazine, but you did not give the magazine yet. So this money that you did not give them the product for are liabilities on you. These revenues that you receive upfront, these are liabilities. Until you provide them with the product, they will become your money. And this revenue will turn into the financial statement as income statement, not on the balance sheet. You will turn them into sales against this revenue. Building. When you start up the business, in addition to the equipment, you have buildings. So building is what the company owns. Of course, it will be considered as asset. What about loan outstanding? What about loan outstanding? When you borrow money, it's a debt. Loan is when you extend the loan, when you give out the money. So when you give a client a loan, it's your money. You have to get it back. So since it is your money, it belongs to the company, so it is an asset. And just the term here, current, this is money that you have to receive during the current year. It's not a long-term loan. It's a money on short-term basis. Money that you extended to your clients, and you have to get your money back within a short period of time, usually 1 year. Loan fund capital. Whenever we find the word capital, this is part of our equity. Whenever we have the capital, it is part of our equity. So loan fund capital, it might be a long-term money that we received in terms of capital from an investor. So it is at that point in time considered as equity for the company. Long-term investment. This is investment that we did. This is investment that the company did. Whatever it is, whether it is capital investment or it's an investment in a certain corporate bond, for example. The corporate bond by nature is a long term. It's more than 10 years. So this investment that we did, at maturity, money will come back to us. So since this is our money invested, so it is on the asset side. It is our money, we put it on the asset side of the balance sheet. Opposing the long-term investment, we have the long-term debt. This is if we are issuing corporate bonds, yani we are borrowing money on a long-term basis. This money that we borrowed, again, as I said previously, at maturity, I have to pay back the money. So this a debt, I have to pay it back. It is a liability on me as a company. And last but not least, it's the loan outstanding, past due. Loan outstanding past due. Whether it is loan outstanding on current that I will receive during this period, during this year, the current year, or loan outstanding that are past due. This is money for me. This is an asset for me. This is money that I have to get. But unfortunately, I was expecting to get that money, to get that loan back during this month, and it was late, 1 month or 2 months. But still, it is my money. I did not lose it yet. I did not take loan loss provision for it yet. It did not turn into expenses. It is still considered as an asset for me.